Hey, good morning, everyone. Marty Missouri here. It's Friday, the 9th of February, 2024, with your economic update. And folks, I'm going to do it a little differently this week. I'm not going to take you through a bunch of the inputs to our index. I'm actually going to take you through yesterday morning's written blog post. But first, let's take a look at the PWA index. We are now continuing to move in the right direction. Negative 14, which takes us back to August of last year. It's been that long since we've had a reading this, air quotes, good. It's still in the territory that says we need to be very wary of recession, let's say over the coming months. But it is indeed improving, and that's something we're paying very close attention to. And if it keeps up, we will be making the appropriate modifications to our core allocation. Right now, we still think we need to be wary of the downside risk that comes with an economic slowdown. Today's presentation, I think, is going to really give you something that you can sink your teeth into in terms of the current setup, how bifurcated it is, and how concerning it still is from a go-forward basis. So without further ado, let me just jump right into that. Yesterday morning's blog post, and I'm sure a number of you video watchers, certainly clients I hope, have read it. But I titled it An Improving Yet Dubious Setup. So thinking through the dynamics, of course, it's all we do around here is crunch data and think about the setup from a risk-reward perspective and allocate accordingly. The rally of December and November actually was, frankly, quite impressive because it had the character that we haven't seen for quite some time last year, and that is that it had good breadth. And justifiably, it brought, I think, a lot of panickers off the sidelines. Of course, professional investors felt like they needed to catch up. A lot of FOMO going into November and December. Sentiment was pretty much in the gutter. We've illustrated that for years, how really, really poor sentiment can be very bullish, particularly when bullish technicals are in place. And that's what I showed you going into November, and that's exactly how it played out. It's the opposite when sentiment is very bullish and the technicals are in place for a fall, which sadly is how it looks right now. But again, these setups don't always work out the way they look on the chart, but that's what it looks like right now as well. And on top of that, as I'm going to show you, breadth has deteriorated. But before we get there, when you understand the theory of reflexivity, that some of that was going on and it showed up in the improved data. And as I've illustrated for you, there's quite the correlation between consumer sentiment and the stock market. But again, animal spirits among businesses and consumers clearly was reignited the last couple of months of last year. And that shows up in the latest sentiment indicators. Here's the Conference Board Consumer Confidence Indicator. Here's the University of Michigan's Consumer Sentiment Indicator. You can see them spiking notably. The ISMs looked like services was going to roll into recession, and it had a nice pop here last month. Manufacturing getting closer to the expansion line. The S&P global PMIs, which they started those back in 21, both moved into expansion territory. Small business optimism still pretty low, but getting a little better. And my second point, the positive market action and sentiment had virtually everything to do with expectations that the Fed will cut interest rates aggressively as inflation continues to come off the boil. And therefore, 2024 recession will be averted, which would be your soft landing. Inflation comes down nicely, and the economy just continues to sail right along. That's clearly the Wall Street and the Washington narrative as we sit here today. As of December 1, the futures market had 6 rate cuts penciled in for pretty much the next year or through January of 2025. Right now, it's 5 rate cuts, so not much has changed, even though the Fed has kind of changed its tune of late. With regard to the equity market, indeed, per the following chart, as I said, breadth got very good. There's the Russell 2000, there's the S&P 500 equal weight, both outperforming the S&P 500 cap-weighted index, which has all that concentration in a few big stocks. So with regard to overall general conditions, and I just showed you that it continues to improve, here's our, the last couple of weeks, now 3 weeks, we've seen nice improvement in our own PWA index, and the copper-gold ratio, despite the last few days, is actually positive. So copper tends to go up when relative to gold when the economic prospects have improved. And just for fun, Bloomberg does a survey of economists and economist types, and then banks chime in as well. You can see their recession probability index has been dropping of late as well. So all in, sure looks like the odds of recession going forward are waning. Now, there's even more that I can throw in there to make that case, but suffice to say that it is indeed the sort of data we look for as indication that the economy is bottoming and it's time to begin positioning, i.e. buying on the cheap for the start of the next cycle. Problem, save for the blip, which was, as we know, rescued by trillions of dollars in 2020, there's been no recession to come roaring out of. And thus, there's little, certainly in the U.S., to be buying on the cheap. The U.S. stock market is far and away the most expensive market in the world. India right now would be number 2, in case you're interested. And when we explore similar phenomena historically, we need to point out that all this good stuff that we've seen of late, actually, it's not unusual at all for it to actually show up right before recession hits. Here's the Conference Board's survey, nice pop right before the early 2000s recession, right before the great financial crisis. Here is the University of Michigan's. You can see the nice spike right before the COVID recession, huge spike right before the great financial crisis, and moving up right before the early 2000s recession. Same thing with the ISMs. The white is manufacturing, the yellow is services. See them improving right before these 3 recessions. And the NFIB, same kind of stuff. You can see, nice pops, right? Nice pops right before recession. And then even our own index, where we went briefly into the red, we came roaring right out of it and then rolled over into the recession. And then the copper-gold ratio, I'm using arrows on this one, but you can see big spike right before the early 2000s, a couple big spikes before the great financial crisis, spike before the COVID blip, and then, as I showed you, moving up a bit here as well. Now, if you look back, though, and I say it here, you've noticed that, in between here, there's all these spikes as well, right? And that's the case on every chart. So you may have noticed that. And in every one of those charts, there are also similar spikes during periods, where there's not any recession, either previously or in the near-term future. So I'm in no way suggesting that the recent improvement in any way signals that recession is coming. I'm just making the point that it doesn't necessarily signal otherwise, as the bulls would have you believe. So while our recession risk light remains lit, we got to continue to hedge and be diversified and pretty liquid and so forth. Now, to drive home the point that maybe we're not out of the woods just yet, New York Fed did some of its work, and this is as of this week. As you can see, credit card delinquencies are going in the wrong direction at a pretty accelerated pace. Auto loan delinquencies among young folks 18 to 29, you can see that's going up. Senior loan officer survey shows continued tightening lending standards, consumer loans against the year-over-year change in outstanding consumer credit. That's not a bullish chart for the economy. Despite recent slowdowns in price increases, Americans still are suffering and complaining about inflation. Consumer sentiment has not kept pace. Even though it's picked up, it hasn't really kept pace with strong economic growth or what you would expect. Restaurant spending slowed in January, although there was very cold weather, so that may have explained a lot of that. Tech layoffs are showing up every day. You're hearing it again and again. And as I said the other day, it's the first thing to go are jobs. CEOs are little more these days than shepherds of their stock price. And they'll do what it takes. Share buybacks, layoffs, got to keep those numbers good for the quarterly earnings reports. Not the ideal situation, but it does work. until the fundamentals catch up. Peter Berezin, very good analyst, chief strategist with BCA, was bullish last year on the economy. He was one of the rare individuals because the consensus was so much in the recession camp. He wasn't. He accurately pointed to pandemic savings still circulating through the economy as being the big thing that kept it going. Now he sees pretty good chance of recession in the not too distant future. He spoke day before yesterday morning to consumer spending. And he said this question, what's going to happen? Well, the savings rate is abnormally low in the U.S. That wouldn't be a problem if income growth were to accelerate, but we're not going to have the same influx of people into the labor market this year. So I think growth is probably going to slow, which means the only way for consumer spending growth to remain robust is for people to continue to borrow. And you can see that there's some problems arising there, as the earlier chart showed. And then he featured that same chart on the senior loan officer survey. He said the correlation is quite strong between bank willingness to extend consumer credit and credit growth itself. Probably not enough, this chart by itself, to induce recession in the 6 months, but it certainly does raise the prospects of a recession maybe toward the end of the year or early next year. He's lowered his odds, as I would say we have as well, but he still sees 10% risk of recession first half of the year, 40% second half, and then he throws some odds into 2025 if it doesn't happen this year. Okay, so from me now back to what the market is pricing, which, as I stated above, has virtually everything to do with expectations that the Fed will cut rates aggressively as inflation continues to come off the boil, and that therefore recession in 2024 will be averted, which again would be your soft landing. Well, that is now even factoring in the not so rosy data featured above, which is these delinquencies and so forth. Gotta say, it's a distinct possibility. But then it even comes with its own challenges. I won't read you this, but excellent research firm called Variant Perception, they're very original, do their own work. Their leading inflation indicators are bottoming and starting to turn up. And that brings us back to kind of the 2022 fears where markets really suffered on the back of rising inflation and a Fed that at the time was tightening, but if inflation comes roaring back, they're sure going to have a tough time easing much this year, and that's very much priced into the stock market. So I can, as you can imagine, I can bolster either case with more data, but back to the breadth. In fact, I showed that it turned upside down from that very rosy look from November and December, but I'll update you that right here. For example, as we sit here this morning, I don't know if this gets completely captured to the right there, but this is the S&P 500. It's actually up 29 basis points as I speak, but 8 of the 11 sectors are actually in the red, right? Utilities, financials, healthcare, industrials, materials, consumer staples down a good chunk, energy down a lot, right? So up 28%, but 64% of the stocks are actually in the red. Folks, that's just not good breadth. And just to drive that home, because I hear a lot of people, heard a really smart sounding gentleman on Bloomberg this morning pretty much poo-poo the importance of the breadth readings. Well, I've been doing this it'll be 40 years in August, tracking breadth and paying attention to it for a lot of those years, and these are my own charts. And these were developed as we went, right? So, here's that NASDAQ advanced decline line, which is about as bad as I've ever seen. And, here it was flattening out right before, some turbulence there in 2019. Here it was rolling over before, the market took a 30 to 40% hit, depending on which index you're looking at. Here it was rolling over, and these are divergences. You have price going up, but breadth rolling over, right? Here it was right before a little warning signal here in early 2021, and here it was really ugly before the previous all-time high, and a 38% hit to the NASDAQ, to this particular index. Folks, here we are with a rising wedge pattern and really, really bad breadth. So we can poo-poo it all day long, but history, and this goes back for decades and decades, history says we should pay attention to it. Doesn't mean that we couldn't get a big broadening out. In fact, I'm open to that possibility, meaning this could correct itself without a big bear market. It's just that the risk is high there. And then let's just run through a couple more, and then I'll let you go. Here's a one-year chart of the S&P 500 versus the equal weight and the Russell 2000. This is just an absolutely historic gap. Update that now to year to date. Not good, folks. You've got basically a runaway S&P because of some huge concentration. You've got everything else pretty much floundering so far this year. Number of S&P 500 stocks. Here we are at all-time highs, and you can see the number of stocks trading above their 50-day moving average, rolling over. This has been a very important and telling indicator for me for several years now. And this is just not a good look right here, and it's pretty much the same look on the slower moving 200-day moving average. As you can see right here, 71% when we're at all-time highs. It doesn't sound like bad breadth. We're just looking at the where it tends to sit at all-time highs and the divergences and so on. So the breadth situation has our attention. The forward-looking economic data has our attention as well, but have to acknowledge that some of these indicators are beginning to show us that there's less odds of recession this year. And I am talking about a very overvalued U.S. market, but there are pockets of value there that we will and have just over the last couple of weeks. We've made a couple adjustments to exploit those values just in case. And we'll do more of that as this goes on, but we are not ready to basically, strap on our skis and go barreling down the hill, or let's say backing up the truck right here and loading it up with the kinds of things we'd want to own during the next bull cycle. That day will come, whether it comes alongside of a recession and things considerably cheaper than they are right now, or conditions actually getting to the point and earnings rising to make sense of some of these valuations to the point where we're there without a big drawdown along the way. I'll leave it there, folks. I appreciate you. Thank you as always for watching and listening, and I'll be back very soon. Take care. Have a great weekend. Bye-bye.